Alright folks, how's it going? So, I realised it's been a while. I mean, I've made a couple of videos in the interim, but it's been a while since I've updated my performance. It's been since the 31st of March, a long time ago. So let's do that now, shall we? I'm going to run through the changes I've made to the portfolio since my last kind of activity update. Because that was like, well, by the looks of it, it was mid-June sometime, because that's the first one I've got in the spreadsheet here for the changes since. So I'll do that, because then when I show you the performance, you haven't been spoilt on what I might have sold. Well, you've already been spoilt because it's on the screen right there. You could just pause the video and read it and not bother listening to me. Oh no, I bought SEIT. Yeah, I bought some that energy efficiency thing that I was in a while back. The thing is, I didn't stay in it very long. That's why it kind of left my mind. If we go up here, we can see here that I purchased it in the SIP and in the ISA, about £3 worth in total, and I sold it on the 7th of July. So that I was in it for less than 2 weeks by the looks of it, maybe less than 3 weeks. Yeah, so I put it all in there. There was a big, dividend cut, and so there was a big drop in the share price, and I thought I'd just go in there. I figured the market had overreacted, because I don't think there was any real bad news about the actual operations of the trust. It was just the fact the dividend was cut is why it dropped. So there's nothing fundamental. It's just dividend investors selling. So I figured I'd just get in there. And when I got in there, in my mind I was thinking it'll be short term, which it ended up being, because I sold on the 7th, which I've put in there. I've sold on the 7th, quick 9% profit. Was it 9%? It might have been less. Oh, some of it was 9%, some of it was 7.8. Yeah, probably about 9% overall. So yeah, I did, and then I got, I put £1 into Trig when I eventually sold on the 7th. Eventually, it was a short period of time, and then a couple of grand into Acqui. Yeah, and well, actually, so yeah, I might have to take back what I said earlier. Maybe it was that price drop in SEIT that triggered me putting 2,600 into the market. Maybe that's what triggered it, rather than me counting my my cash balances. Yeah, I've no idea. I should write more, shouldn't I, in these little notes? And on 30th I added a load more. Oh, this is when I looked at my cash balance, because look, I've written it here. It leaves me with 17 grand cash outside of my portfolio, which leaves for a 10 grand car if I ever wanted to move back to England. This is my emergency buffer. I've spoken about it a few times. And it's earmarked as like 10 grand for a car, 7 grand as a spending buffer. Oh yeah, and it says there, based on my needs outside and not market timing, because it was not a good market timing. Yeah, and then I've already said that. And then on the 22nd of July, I sold NatWest Group. It's had a pretty good run. I figured, as I said, when I started making the total return portfolio of just the ETFs, the passive ones, I'm just going to wait for a decent little run for most of my stuff, and then sell it and put it into the total return portfolio. And by the looks of it, adding to Acqui was what got me to balance in that total return portfolio, because I did the same on the 23rd when I sold Legal & General. But we can see here that in the individual, the Legal & General made me 25%. That was a pretty good investment actually for me. I don't normally get such good results in such a short amount of time, because I've only owned it like maximum 2 years. I haven't got the dates there, but it can't have been more than 2 years. And there was a pretty good dividend. There was like a, I don't know, 7% dividend or something when I bought it, maybe even higher. So yeah, I'm out of all the financials now, all the UK financials, I'm out of them. And then I sold RGL, which is the regional REIT, and I put it all into S3. Basically, it's because the market has not liked Schroeder Real Estate Trust buying part of Picton's portfolio. They're along with London Metric, they're buying Picton out. So S3, the one I own, they're buying some of the properties. London Metric are buying the other properties, and the market hates it, and it's gone down quite a bit recently. So I figured it was a decent time just to put all my money into S3, because I think it's the stronger portfolio, but it was at the much lower valuation. At the moment, it's at a 5% discount to NAV. When I switched from RGL to this, it was at a 27.5% discount to NAV, I think. But regional REIT was at about 40% discount. But that differential in those discounts has historically been a lot bigger, because I think Schroeder has the better portfolio so the sentiment on regional REIT was a lot lower. And this had a slightly higher yield at the time that I did the switch as well. So I just decided to put all of my REIT money into Schroeder Real Estate Investment Trust there. And it's, it's recovered by a couple of percentage. I've actually kept as the cost basis. I've kept the cost basis of regional REIT because I don't want to set the, because I sold it at a loss. What was the loss I sold it at? Oh, in one account, which was only 50 quid, it was a 3% gain, and the other account 11.5% loss. So what I've done is I've kept that 11.5% loss in the number that's being tracked here, so that I don't fool myself, thinking, oh, I've made a profit on my REIT, so I'm good. Because no, the one I've sold and put into here was sold at a loss, so I've kept the loss in this spreadsheet. Okay, so that's all the activity by the looks of it. And the performance that we've had since last time, since the 31st of March, I've actually beaten Life Strategy 100 for a change. Well, only marginally, but as you can see from the beginning of the year, I'm still losing to it and winning against the others. And as usual, I'm never going to make up this differential. I can't see it ever happening. What is that? 40, 50, 60, 73 percentage points behind Life Strategy 100, which is terrible. And then even Life Strategy 80, I'm well behind. But but I'm catching up on Life Strategy 60 though, which isn't a big, considering my portfolio barely has any bonds in it, is not a big brag, is it really? Because I'm still losing to something that has 40% bonds. So yes, terrible. And then the dividends I've received since the 31st of March are 5,149. It's a meaningless number really because it depends on the time frame. And actually it's becoming even more meaningless considering what I'm now doing, where 9,000 of my dividends is what I sell from the total return portfolio. It's what I sell from these black bold holdings here. So I could make that as high or as low as I wanted. I'm deciding. What have we got? So all share 12.71. That's 12.71. Last strategy 100 is 12.06. Okay, so the UK weighting hasn't helped in this time frame, has it? Yeah, this one's done really well. It's had a big fall off though. A lot of it is, you instinctively think a world value ETF is going to be less risky, don't you? Because it's got the word value in it. But actually, if you look at it, a lot of the good performance this one's had since I bought it and before is because of the top holding. And if you think about what a value stock is, this top holding, considering what we hear in the news, this top holding isn't probably what you think. Micron. It's one of those, it's like almost a meme stock. Well, it's not really, because the earnings of this company have skyrocketed because of the short supply of DRAM, I think it is called. But look, it's 13% of the portfolio. It went up to like 20% at one point. So yeah, it's like we've gone for a world value thing, but we've ended up in something which doesn't feel like value because it feels very much AI-ish, doesn't it? It feels very much like it's in bubble territory. But the bubble here that people think might be happening is the earnings, not the share price, because obviously it wouldn't get in this world value ETF if it didn't have a low enough price to earnings ratio. And it's true, it does have a reasonably low price to earnings ratio. It's just the E. People think the E might be too high, and that's why it's got this kind of feel of like a momentum stock rather than a value stock. Intel was in here, and then at the last reconstitution, is that what it's called? Got kicked out, probably because the earnings didn't keep up with the share price. So it does look at value. It's just that this is still got a decent PE. It's just a very cyclical, commodity-based sort of business, I think. But yeah, it's been doing very well because of that. But actually, it's had a big fall off as well. I don't like this new Google Finance, by the way. See, it was up here. Oh no, it's had a. Oh yeah, so it's had a bit of a comeback. I guess the other holdings in there have helped it not fall quite as much. So it was down 6% at one point. But for a lot of the time, it was falling more than my other stuff because of Micron. Because if we look at Micron, which was about 20% of that ETF, that's why I'm focusing on it so much. See, Micron's down 27%, but that's the beauty of a collective investment, isn't it? The top holding was 20%, and that top holding's fallen by almost 30%. Yet the ETF itself is only down about, what was it, 3%, 2.68? Yeah, it's only down 2.68. So even when ETFs get really top heavy like this one did, and still is, it's still got enough diversity in there to protect it. When Micron, when its top 20% holding falls by 30%, it's still got enough diversity in there. So yeah, that's kind of reassuring, isn't it? That even in these extreme portfolios, the diversity is working well for us. But anyway, how have these done? BlackRock smaller companies, decent performance for that, considering how bad it's done over the past 5 years. Same with Scottish American, and then GSK's done badly. Pfizer. These two have had a little bit of a comeback recently, like the past few days, the past week. They've had a good little comeback. And then, as I said, Schroeder Real Estate has gone down. Go Street Energy has been going down since March. I think Sauber has, what's the phrase? Is it requisition the board? It's some technical term. I think they're going to demand that the whole thing gets sold. In a similar way, NESF has also, I don't know who instigated that, but they've also put themselves up for sale. So I mean, I don't like that really. It feels a bit desperate to me. Do it quietly is what I say. Find a buyer quietly, or do it piecemeal. Quietly. Don't tell the whole world you want to sell, because then no one's going to offer you decent money, are they? I think they might just be difficult to sell. This one in particular, I think this one might be difficult to sell in one go. You have to sell this piecemeal, I think, because it's got American battery storage. I can't remember the exact regions, but it's all over the world. So, like the Harmony Energy one that I owned and got sold as a whole thing. I'm pretty sure they were all in England. So the simplicity of that portfolio probably made it more suitable for a wholesale sale to, I think it was Octopus Energy or something. That's the other thing, the buyer wouldn't want all of the American stuff that Go Street Energy has. So I think that's why selling it as a whole is a bad idea, and they should just do it quietly, which is what I think secretly they were doing, because they were saying that they were strategically selling stuff, or they use fancy words. They were selling assets, but they were trying to do it in like a subtle way, so that they didn't signal to the whole market that they were desperate to sell. They were just doing it gradually and selling it gradually and paying a big dividend. So it was. I think they were selling down the portfolio, but without declaring it to the world, because declaring it to the world is not the smart thing to do. But anyway, we'll see what happens, won't we? Yeah. So what I was pondering was, at the moment it's 2.44% the yield on this total return portfolio. I've got penciled in a 6% rise, as I've mentioned before, for next year, which will start next year, and I'm going to do it gradually. The rises in, rather than doing it, like every payment being the same for the full year. What I'm going to do is something like this. So I mean, this is just how it would be. If this year's was 1,000 a month, this is what next year's payment would be, by increasing it by 0.4867% each month. That adds up to a 6% return. So I've just kind of trial and errored my way to 1,031. And these are the numbers that get me to a 6% increase. So obviously it's not 1,000 at the moment, but what we can do from here is we can say that divided by that is a 3%. If we add to it's a 3.19% rise. So I will do a 3.19% rise from the last total return payment I'm doing here, 766. And the reason I'm tracking this 1,000 going up is because obviously I'm adding cash to the total return portfolio quite consistently. Each time I sell something from the rest of the portfolio, I'm adding it to it. So this is, I suppose it's kind of like a unitization really. I'm tracking what would have happened to the 1,000 if I did the same percentage increases that I end up doing here. And I think what I might do is, I've penciled in 6% this year, but I'm thinking I might start at some point. I might start just doing whatever the RPI, or I don't know actually, maybe a different measure of inflation. Maybe I might do because I'll be renting probably for the rest of my life. Investment dividend growth. Nope, that's the wrong spreadsheet. What I'm thinking is, because I'm renting, and probably will probably end up trying to rent for the rest of my time. Maybe CPIH, that includes housing costs. Maybe I'll increase my payment from the total return portfolio by this amount, whatever the differential is month to month. So here we go, month to month. So that is just March to February's percentage increase. Maybe I'll adjust it by that amount. But then if the portfolio ever does really well, and let's say at the moment we're at 2.44%. Let's say that if the portfolio got down to 2.3% because of good performance, maybe I'll step it back up to 2.4%. So that whatever that month's rise should have been by CPI, replace it with whatever gets us back to 2.4%. So it'll be like restarting at 2.4% my sequence of return risk, and then next time I do like a step upwards in the income I take from the portfolio. Maybe I'll wait for it to go down to 2.2% and then boost it up to 2.3%. So that each time I'm kind of resetting my withdrawal from the total return portfolio, each time I'm doing that, I'm doing it at a lower initial withdrawal rate. So eventually, because if you keep resetting and starting again, it's like, for instance, say if I chose 3% as my overall withdrawal rate to start at, and I kept going back to every time the portfolio did well and this number got below 3% again, and I increased my withdrawal back to 3%, each time you do that, you're getting closer and closer and closer to having a sequence of returns which matches the worst case scenario that you get on those like simulations. They're using they use historical data. They do simulations based on the historical data, the inflation, the returns. And what you do is by increasing your income by more than inflation, because your portfolio has done well, you are getting yourself closer to that worst case scenario. So the way I see it is by reducing the initial withdrawal rate, because you're restarting, so the initial becomes each new time you boost, you kind of step up your income, it's kind of like starting again, and then you've got the sequence of return risk to go through once more. But the lower the initial withdrawal rate, the less bad that worst case scenario is, if it ever happens. The one that rhymes with the worst we've had in the previous. I think it's like 1966 might be the worst one, because inflation got really high. So it's like I'm allowing good performance to increase how much I take and spend in my real life, but I'm also incrementally making that worst case scenario less bad each time I do that, because I'm making the starting yield lower and lower each time I do it. So that's what I'm thinking I might do in the future. I mean, at the moment, I'm not going to do that, because I've still got too much of the portfolio that's not in there. Because really, this is the yield, really, 2.72, rather than the 2.44 I've got here. At the moment, I think I'll just, pick numbers like this, somewhat out of the air. Somewhat I might base it on the inflation data. Like, this inflation data seems to be hovering around 3%. These are the year-on-year changes. So I'm thinking, I'll have a real 3% pay rise, because the inflation might be up 3%, but I'm paying myself 6% more. But yeah, at some point I might do that kind of ratcheting thing that I just spoke about, where I allow the performance of the portfolio to inform my lifestyle changes. And if I don't find anything to spend the money on, I can just reinvest it in the portfolio, and then that increases the income potential for the future years. There's an overview of the portfolio. Yeah, this is the one I want to get rid of next. I'm thinking to myself, if I get even on this one, maybe I'll put that into the total return portfolio. And I'm thinking for these two, I might just do it as simply as just waiting for the yields to be equal. So when 2.44 equals 2.88, I might sell Scottish American, is what I'm thinking. I don't know. We'll see. But yeah, I mean, if there's ever a big performance differential between any of these, I'll probably sell it, But then on the other hand, sometimes I I just have a random moment where I think, oh, I'm just going to do it now. It's very much based on my emotions when I decide to make these moves. Alright, that'll do for this video, I think. I'll see you next time. I was going to show you some photos, but I've looked through my phone and I've literally taken nothing that I can show you. Because I've got, like, there's only about 5 photos since the last time I showed you them all, which I think was like the end of March. There's literally about 5 photos, and they've all got my face in it. I don't want to show you my face because I'm very shy. If I ever bumped into anyone in real life, I get very tongue-tied and I don't like it. So I don't want to show my face. Alright, I'll see you next time. Bye-bye.